I don't want to be overly dramatic, but I think I will use the word doomed in the long term.
The United States dollar is the world's most powerful currency. Analysts have been warning about the dollar's eventual demise since its inception in 1971. Some experts believe the dollar's dominance is in jeopardy as its share of global reserves continue to fall. So, what would happen if the dollar lost its role as a Federal Reserve currency? Find out by watching the video. Hey folks, welcome back to our channel. In today's video, we will show you why the US dollar may be in danger. Before we get into the video, don't forget to drop a like on this video and subscribe to the channel if you haven't already. Make sure that the post notifications are turned on so that you never miss a video from us. Without further ado, let's dive in. Will the US dollar collapse? There are a number of possibilities that could result in a sudden worldwide recession. The dual threat of high inflation and high debt, in which rising consumer prices force the Fed to hike interest rates sharply, is the most plausible scenario. Because much of the national debt is made up of short-term instruments, a rate hike after the teaser period would behave like an adjustable rate mortgage. If the US government is unable to meet its interest payments, international creditors may dump the dollar, causing the currency to crash. Users may abandon the dollar if the United States enters a deep recession or depression without bringing the rest of the globe down with it. Another possibility is for large power, such as China or a post-EU Germany, to reintroduce a commodity-based standard and monopolize the reserve currency sector. Even in these circumstances, however, it is not apparent that the dollar would certainly collapse. The dollar's demise is still a long way off. Only the likelihood of greater inflation looks credible among the preconditions required to induce a collapse. Because the United States is such an important customer, foreign exporters such as China and Japan do not want the dollar to fall. Even if the US had to renegotiate or default on some of its debt obligations, there is no evidence that the rest of the world would allow the dollar to collapse and risk contagion. The United States may be at a risk of losing its status as the world's reserve currency after more than 80 years of dominance. Around 60% of the $12.8 trillion in global currency reserves is held in dollars, giving the US a major competitive advantage over other countries. That honor, however, comes at a cost. Because US government debt backed by the currency is particularly desirable, interest rates are lower. The US can borrow money in its own currency from other countries, which implies that if the dollar increases in value, so does the debt. Businesses in the United States can conduct international transactions in dollars and avoid conversion fees. Most crucially, in severe circumstances, the US can cut off dollar access to central banks around the world, isolating and draining their economies. Raghuram Rajan, the former governor of the Reserve Bank of India, referred to this capacity as an economic weapon of mass devastation. The US used this weapon when Russia invaded Ukraine in February, blocking $630 billion in foreign exchange reserves and substantially weakening the ruble's value. As a result, the United States was able to punish Russia without putting American troops in a war. However, great power comes with great responsibility. When a weapon of mass destruction is used, even if it is an economic weapon, people are terrified. To avoid a repeat of Russia's destiny, other countries diversify their investments away from the US currency and into other currencies. The country's status as a reserve currency could be compromised under this situation. Weaponizing the capital, according to Bank of America strategist Michael Hartnett, might lead to its debasement. He went on to claim that America's role as the reserve currency is being eroded by the balkanization of global financial institutions. The dollar's share of worldwide reserves has been declining for the past 2 decades, roughly coinciding with the start of the US war on terror and counter-terror measures, according to a recent analysis by the Foreign Monetary Fund. Since then, 1/4 of the reserves have shifted from the dollar to the Chinese yuan, with the remaining 3/4 being invested in smaller country currencies. The paper's co-authors, IMF's Serkan Arslanalp, University of California, Berkeley's Barry Eichengreen, and IMF's Chima Simpson-Bell, cautioned that these observations provide indications of how the international system may change going forward. Russia and China are also attempting to shape the future of the international order. Gas supplies to countries that do not open a Russian bank account and pay in rubles has been threatened by Russian President Vladimir Putin. The European Union imports roughly 40% of its gas and 30% of its oil from Russia due to a lack of suitable alternatives. Meanwhile, Saudi Arabia is in talks with Beijing to accept yuan instead of dollars as payment for Chinese oil deliveries. Will the king dollar be on the verge of being dethroned? If the past 2 years have taught us anything, it is that nothing is impossible. However, it is extremely unlikely that the US dollar will lose its obscene privilege. For starters, the alternatives aren't exactly enticing. Although China has been promoting the yuan for years, it only accounts for approximately 3% of global trade compared to 40% for the dollar. The United States continues to attract the attention of the rest of the world. The stock market in the United States is the world's largest and most liquid, and foreign money is pouring into the country. Global foreign direct investment flows climbed by 77% to an estimated $1.65 trillion in 2021, according to the United Nations Conference on Trade and Development, while investment in the United States increased by 114% to $323 billion. We may not love the second quarter, but at the very least, we will be prepared. This week marked the end of a wild first quarter in 2022, with major market indices registering their worst results in 2 years. Investors faced a range of exceptional challenges as a result of inflationary pressures, Russia's invasion of Ukraine, and the Federal Reserve's rate hiking policy being hastened. Those problems will continue into the second quarter. The devil you know, on the other hand, is frequently better than the devil you don't know. Analysts think the biggest headwinds would be in the coming quarter and how they plan to deal with them. Here's what they discovered. Russia's invasion of Ukraine has stunned markets all across the world. The geopolitical upheaval has impacted energy markets, commodities, and even food poverty issues. Josh Leonardi, Director of Prime Services at TD Securities, is heading to commodities markets where raw materials are traded to hedge against the Russian conflict. One of his favorite foods is wheat. Around a fifth of the world's wheat is grown in Russia and Ukraine. Future agricultural contracts are soaring in price as supply tightens and demand remains stable. Oil and energy are commodities that have traditionally been extremely volatile and reactive to news updates, so it's usually best not to invest in them. According to Leonardi, the United States is currently dealing with an inflation problem that it hasn't experienced in 40 years, and it's time to look to real assets as a hedge against inflation. This requires, among other things, investing in commodities, real estate, land, machinery, and natural resources. He says that real estate investment is becoming increasingly popular. I'm not sure there's anything hotter on the market right now. There are single-family and multi-family homes, computer centers, and cold storage facilities to choose from. When investing in the stock market, look for companies that profit from inflationary increases. As interest rates climb and spreads widen, banks profit more. Low capital requirement businesses are also a good bet. The Federal Reserve will most likely hike interest rates aggressively in the future. According to Liz Ann Saunders, Managing Director and Chief Financial Strategist at Charles Schwab, the Fed put is a safety net that many investors rely on. The notion is that if market volatility is high enough, the Fed will stop raising interest rates and tighten policy, or perhaps reverse and loosen policy. According to Saunders, there's no way that will happen this time because inflation is so high. Investors should be wary of this, especially if they are more risk-taking and feel the Fed will not let the markets fall. To slow down the economy, they'll keep raising rates. As a result, the chances of a recession are higher than they would be otherwise. Did you find this video informative or helpful? Let us know in the comment section down below. Make sure to subscribe so you don't miss out on my future videos. Don't forget to like and share.